Hello, this is Brian Rezny, President of Rezny Wealth Management, bringing an important update and question and answer day. You know, we're getting a lot of questions on my TV and radio show, and it's interesting with all the volatility we've had in the equity market. Of course, we are starting to get a lot of questions about bonds. Can bonds go down a lot more than they've already gone down? They sure can. Remember, if the Fed keeps raising interest rates, when rates go up, bond values go down. Bonds are not safe investments. Again, I want to repeat that. Bonds are not safe investments. People have been maybe schooled, however you want to put it, taught, disciplined, explained that bonds are a good hedge if the equity market goes down. What's interesting is the bond market, a lot of the bonds, depending on maturity level, bonds have gone down more than a lot of the equity market has gone down this year. So what do? Is there time to change some of that bond portfolio? Potentially. One of the things that we always look at is where are we at the cycle of interest rates and what will the Fed ultimately do based upon the economic uncertainty that we currently have, and if we look at the next 6 to 12 months. Because really the Fed's going to take a look at this inflation factor. Is it abating? Is the consumer now starting to get somewhat tapped out from that free stimulus money? And will that abate more on the inflation factor? Of course, the supply chain numbers are starting to get fixed, so we did have elevated inflation from that. The biggest factor, I think, if I look at the next 6 to 12 months, and really the next 3 years, is going to be energy prices. Those are going to be elevated regardless if Russia pulls out of Ukraine. And the reason for that is because the U.S. is no longer energy independent. The economies of the world are coming back from the COVID from a few years ago, and people are traveling more, driving cars and things of that nature. So ultimately, we're going to use more energy over time. Even at $5 a gallon, people will still drive their cars, and maybe they won't do other things in order to fill that gas tank up. So what we ultimately see is this: inflation coming down from the highs we see, still being elevated probably in that 3 to 3.5% level easily if I look at the next 5 years on average because of energy. And again, energy runs everything. Your electric bills are going to be higher if gas and oil and coal is obviously up. These things have a negative impact on the consumer and the majority of consumers. But if we have a different policy in the White House, which this current administration I would not look for, I think oil has great potential the next at least 1 to 2 years. And again, depending on what the policy of the administration is. We currently own oil investments in our portfolio, but we bought them almost 2 years ago when oil was dirt cheap because the current administration was coming in and their stance on oil and gas and fossil fuels in general. So ultimately, as an investor, you need to look at the future and say, based upon current policies or policies that are going to be put in place, where are opportunities for my portfolio and where should I currently be positioned? Should you be selling more bonds in your portfolio and reducing and adding cash if you want to be more constructive or conservative? Should you be adding oil at these current prices? What about the equity market? Are the equity market in the U.S., especially semiconductors, a great opportunity now because a lot of those are down 20 to 50% from their ultimate highs from just 6 months ago. These are important things that research does in a portfolio and things that should be part of your research that you do every single day. If you're finding the firm you currently use is set it and forget it, client communication is awful, call Rezny Wealth Management. I'll give you a quick little history lesson what happened this morning. Before I did this update video, I had a newer client come into our office, hired us about 3 months ago. Had a nice portfolio close to $2 million. Was not happy with the current big bank that she was working for because she said it was pretty much set it and forget it, and the client communication was awful to boot. The only time she would hear from them is if she initiated the call. She said, being with your firm for just the last 3 months, not only am I happy with the way you're managing our portfolio, but your client communications is spectacular, and you actually reached out to me in order to schedule my first review and update to go over my portfolio. These are the important factors of a quality, real fee-only fiduciary money manager versus a Wall Street style firm, bank, or insurance company. So again, if you've got a larger portfolio, you want a real money management firm, call Rezny Wealth Management. We'd love to talk to you. Have a safe and profitable day.